Howdy, Jacob here. Today we're looking at CSX Corporation in the ground transportation industry. Got a rail-based freight transportation service founded in 1978. 65 billion market cap, 81 billion enterprise value. Growth is not very substantial, 12.7 billion to 14.7 billion, with pretty good margins though. There's essentially nothing between their gross and operating margin, which seems very odd to me because someone's got to be running these things unless they unless it's just pulling in super weird and cost of goods sold includes sales, general, and admin and other operating expenses. But yeah, it seems weird to me they wouldn't have any operating expenses. Either way, pretty good margins, huge reduction of shares from 3 billion to 2 billion. Third reduction there, pretty big. Good return on invested capital, but it looks like they're buying back a lot of shares and paying a dividend. So the premium isn't necessarily required there because, again, return on invested capital being immense would only push a premium if they're reinvesting the money to get that rate of return. If you're just paying a dividend or buying back shares, you're not actually getting that historical rate of return. And so keep that in mind as you do your own analysis. The balance sheet shows $1.4 billion cash-like products with $558 million short-term debt, $18 billion long-term debt. That $18 billion in long-term debt in relation to their free cash flow is a little over 5 years. So, not a make or break number for me, but to invest in this company, I would need to see more than 1 year of the last 10 years of debt reduction. So again, I know this might be not, the boldest thing, but I do think that having a lot of debt and leveraging yourself doesn't make it safe for me. And I want a safe investment that I think has the highest probability of a great return. And when you have debt, yeah, this company hasn't not made money in the last 10 years, but again, anything can happen. And so I don't want to test those waters. I don't want to leverage the living company and snot of the company to where it is all debt. All their investments are just going straight to interest. Like, that's not something I'm looking for. So I do want at least a little bit, or in my projections, I will put a little bit of capital allocation going towards debt reduction. Otherwise, tiny bit of acquisition and then a lot on share purchases and a little on dividends. Let's get right to it. On the revenue growth side, I think pretty much inflation seems reasonable to me. I think that their enterprise value is a bit higher, but I'm assuming a little bit of debt reduction. Whether that happens or not is a different story. But that operating margin, as high as it is, and I think any railway company has some sort of a moat because the barrier to entry is massive. Like, no one's going to spend 5 to 10 years to put down railways that are already there and businesses already make money. It's too difficult to get into. It's not like tech where consulting, you just kind of come in and boom, no money down to get it going. So the world's just kind of changed a little bit. I think that railway companies definitely have barrier to entry, and it's immense. So I think that deserves a premium. Consistency deserves a premium, but growth deserves a detriment to me. So I think market average is what I'm going for in my projections for PE and price free cash flow. Very consistent though here, so a little bit of a range. 1% share repurchases is about 650 million, which means 3% would be just under 2 billion is quite a bit of that free cash flow. So I'm good assuming 3%, because that's what I assumed. 650, 3% of that, almost 2 billion. And that on a payout basis is between 50 and 70%. The dividend paying out just under $1 billion is going to be mostly remaining of the capital allocation. And so they've increased that. I'll increase this with revenue growth And then what I'm going to do is actually dampen this share change to 2%. So we're at about 1.2 billion to share purchases, just under $1 billion to dividend, maybe 200 mil to acquisitions, reinvestment, still leaving 20% at least of capital allocation going towards debt reduction, which again doesn't really show here. But again, we have to balance out what the company's done historically with what we want them to do. And so that's why I dampened their share change figure a tad to 2%. So with these assumptions, we're saying the company's price needs to fall 45% before you get the return we're looking for here. So to me, those railway companies, barrier to entry is absolutely incredible. But for me, I'm still waiting at this price point. I hope you enjoyed the video and have a great rest of your day. Thanks.